Hey everyone, this is Mike Bonn with the Cash Flow Company. Today I want to go over what the Fed is doing will help create more wealth and income over the next 2 or 3 years than it has in the last 3 or 4 years. And I want to do this with just simple math, just so you can understand. Real estate investing is all about, number one, leverage, and number two, using math to your advantage, and not hard math. But I just want to show you some examples how people create wealth during these kind of times where interest rates are high. Property values actually have maintained here, but there are some good deals out there. If you could buy a good deal right now and using the interest rates of today, meaning the SCR maybe around 8, 8.5, conforming 7.5 to 8, if it qualifies now, we're going to show you how this is going to create that generational wealth that you've seen other people do in the past. Simply put, as I said before, it all comes down to numbers, math. We're all in real estate investing to create income, to create wealth, to create a better life. So we have to understand exactly how interest rates help you create that wealth when rates are high. If you could buy a good value add property in this kind of market that cash flows at current rates, what's going to happen when interest rates decrease? This is where wealth is created, and you're going to see not only increase in income, but increase in equity. Right now, we have a property ourselves that we just put together as a 5-plex, and we're refinancing it into just a short-term loan because we know and understand interest rates are going to decrease. But let's just look at an example of something like this. Say you have a 4-plex that you could purchase, and your loan right now is $500,000. At a current rate of 8.5%, your payments are a little over $3,800. And I'm not saying that 8.5% is the rate you'll get or you can't get better or anything else like that. It's the example, it's the numbers that we're going to go through. So in this example, we have a 4-plex, loan amount $500,000, interest rate 8.5%. What happens next year when rates decrease? And more than likely they will. It's a presidential year. Fed is hitting their top, their apex, and they're going to start coming down. So what happens to not only the income, but the value of that property, that $500,000 property? So we're into a shorter term, 3 or 5 year fixed on it. Let's say next year we decide to refinance it when rates are down to 7.5. I'm not saying we are going to refinance it. I'm just saying let's look at what would happen to the income and value. You have a loan of $500,000 at 8.5%. So your payments, like I said before, are just a little over $3,800. If you refinance it at 7.5%, that saved $500,000 now has a payment of $3,496. The same property, the same loan, just because of interest rate changes, has increased the income almost $350 per month. So over a year, that same property is going to bring in an extra $4,000. What does that mean? If someone is out there, an institution or an investor, they're looking at a certain return on their money. Next year, when that interest rate is 7.5%, someone could afford or pay, because remember, right now at $500,000 and at 8.5%, you are making a good income. Next year, someone comes around and says, I want to make that same income. But now rates are 7.5%, what is equal to this payment you have now at 8.5% to 7.5%. And what you find out, the value goes up 10%. So that $500,000 that you have now has a value of $550,000. So if you don't do anything, you're just going to refinance in the 7.5%. You now have created 10% equity into that property. Not only that, but like I said before, you've increased your rental income by over $4,000 just by lowering your interest rate and thus your payments on your mortgage. This is how you see all these people who have all these large properties with little to no money on it, because this same property, when rates go down, they go down again to 5.5%. That's not even where we were a couple of years ago. That's just a median of where we've been. The value goes up to $675,000. So that property over a couple of years, just by the interest rate going down, has increased from $500,000 to $675,000. That's a 35% increase in just the value. Plus you're paying it down. This is how value is created. Look at that same example on a $2 million either portfolio, multifamily, those same numbers. It has payments at 8.5% of over $15,000 a month. Interest rates go down to 7.5%. Your payments go down over $1,000 a month. That's over $12,000 extra income in your pocket by not doing anything but refinancing. But what happens if you wait and it goes from 8.5 down to 5.5? Your payments are over $4,000 different. Not only that, but your value shoots up from that $2 million portfolio up to 2.7. Nothing else has happened out there except interest rates have gone down. Your value goes up because investors are looking for a certain return, especially institutional investors. So institutional buyers are out there looking at cap rates. What are they going to net after the property? So as rates go down, they could pay more for a property because they're still going to net the same amount. So as rates go down, if you find properties right now and you're taking them into your portfolio with the higher interest rates, as rates come down over the next 1, 2, or 3 years, when you go back to refinance, you're going to increase your income and you're going to increase your net worth. Even if you don't sell them, this helps on your PFS, your equity statement, all those kind of things, because it opens up other things like lines of credit, cross liens, anything else that allows you to keep increasing your portfolio. But the big point is this: if you buy something right now, rates go back down, it's just like adding extra income, extra rentals without adding extra rentals, because your income increased by just taking advantage of, or when rates are high, buying something good, and then as rates decrease, refinancing into those rates to increase your income and your net worth. This is the time over the next year to be buying rental properties at cash flow. Cash flow in this market, so when rates come back down, your income's going to increase, your value's going to increase. So if you don't want to keep the property, guess what happens as rates decrease? There's more buyers out there for it. It might not be institutional, but your households out there now who qualify to buy that single family or that duplex. There's going to be more buyers available as rates go down. So one way or the other, if you're buying properties in 2023, that cash flow, it is going to increase your net worth, your income, as the rates go down. One thing I suggest is you keep an eye on where rates are. 2 years ago, plus you didn't have to worry about it because rates were at 2.5. They're silly rates. Now things have changed. You want to keep an eye on them. You want to know what's the best out there. We have an investor mortgage report that keeps you updated on the DSCR, the conforming, bank rates, private money, what's happening in the market, so you can know if you're paying too much or if you're in the market. Just reach out to me, Mike at the Cashflow Company. I'd be glad to send it off to you. It comes out about weekly, unless there's a major change, but it is something you need to keep an eye on as things change rapidly. Things are going to still increase probably through the end of this year, but then start coming down. So the next 2 or 3 years, it's going to be a great time to be an investor. Now let's keep the money train rolling. We'll see you on the next video.